To talk more about the markets, let's bring in Kristen Bitterly. Could be Kirsten, but it's not. Head of Capital Markets for the Americas at Citi Private Bank. Another morning where there's upward pressure. Is it all real? Sometimes I wonder what's happening, and I wonder if it's something that we're not talking about. Is it just a great consumer, great economy, things are really percolating, or is there something that make it less real?
It is a great consumer, and there's definitely great data about the economy. I think the one thing that's really interesting is a lot of people haven't participated in it.
Still?
So when you look at 2019, it was almost a story of looking at the markets, or 2019, it was looking at the markets, you basically had risk on in terms of performance, but it was risk off in terms of flows. Most of the flows went into cash, they went into US Treasuries, they went into investment grade debt. And so the question right now is, who is participating in this? So our advice to our clients is stay invested or get invested.
I saw an article over the weekend that said the most overvalued S&P in history. And so I went in to see exactly what they were talking about. They found a couple of metrics. I think it was cash flow or EBITDA or gap earning. They did find two metrics that the highest they've ever been.
Okay.
And therefore be ready for, have one foot out the door, or just know that the market's not cheap. Is it justified?
When you look at anything in isolation, I think if you pull out one metric or two metrics, and so we maintain a bear market checklist at Citi where we're basically saying, should you buy the dips? Is there concern about a recession, or should you actually go in and buy the dips? Right now, there's 3.5 red flags out of 18. So the important part is, how many flags are you looking at? 18, 3.5. To put that into perspective, in 2000, it was 17 out of 18. In 2007, it was 14 out of 18. We would start to see some concern if it was 7 or 8, but at 3.5, we're buying the dips.
Pretty unprecedented, I guess, just the length of not just the recovery, but of the bull as well. And I mean, we're closing in on 30,000.
Here's the other thing, though, with equity markets versus fixed income, another anomaly. Last year, the bond market was more of an anomaly than the equity market. And so when we look at if X the U.S., 53% of the world's debt is negative yielding, the average yield globally right now is 1.6%. That includes emerging markets, that includes high yield.
That's
and so
crazy.
What are investors going to do? I mean, just think about that, where you normally had fixed income as your steady income. So one of the things we're talking to investors about is stocks for bond people. You need to find your yield somewhere.
And that in itself may actually propel markets even further this year, because you have people switching in who hadn't been there before.
Exactly. And we're actually advising our clients not to stretch too far in the bond market. And we're seeing that, right? When you look at credit spreads, you're seeing that in the bond market. There are some much better values in the equity market.
Yeah, I think high yield is only yielding like 5.3% for U.S. corporates.
Yeah. I mean, when you get to these, what look like unheard of numbers on all the averages, it just feels like, since you've never seen them before, that it can't go much higher. And I think that as long as you have that feeling, maybe it does go higher, because it's even more surprising than going down.
I think people felt that way at the beginning of last year. They felt that way 2 years ago. Now, two things we're keeping a very close eye on. So one, obviously trade. This phase 1 deal coming to completion. I don't think the market is that concerned about phase 2 right now. I think phase 2 has been basically pretty well signaled that could happen after the elections. Trade's very important, and also a turnaround in manufacturing. So the recession that a lot of investors may have been anticipating was the recession that we saw last year in manufacturing. What's happening right now, though, is you have this situation where demand exceeds supply. And if we start to see a turnaround in some of that data around manufacturing, some of that is priced in, but there's still some that we could see come through in earnings, come through in the economic data, that would be a support to equity markets.
We got to leave, but what would cause consumers to rein things in? I mean, geopolitically, we thought we were on the verge of war. We worry about, constitutional crises with impeachment and everything. Is there anything that would cause people to say maybe there's a problem here and I shouldn't be quite as freewheeling, or what would it be?
So you can't trade around political events, geopolitical events, anything where you don't know. And that's one mistake that investors are making right now, where you kind of look, and investors are almost taking too long of a game. they're looking out and saying, I'm so nervous about what could happen in 2021 or the outcome of elections.
Yeah. Sooner or later, we're all dead,
now.
too. So, but it'd be nice to leave a big chunk of change, I guess. Anyway, unless you get those estate taxes too high, Andrew. I mean,
that's a whole other issue.
That's we got to do the step-up basis. Let's start with that.
We should.
Kristen, I know you like a book. Kristen, thank you.